Brenton Harrison, and we're here today to talk about how much you should actually have in your emergency fund. Let's get started. 3 to 6 months expenses is probably the amount you've heard you should have in your emergency account since you first stumbled across the field of personal finance. But where did that number come from, and is it the right amount? Do you actually need more? Do you need less? What's the justification for 3 to 6 months in the first place? Today's video is going to cover all these topics, and to me, there's going to be some opinion versus fact in this conversation because a lot of this is subjective. The amount you need in your emergency fund is based on various factors that might be at play in your finances that aren't in play in another person's. But in totality, I would say, again, in my opinion, that the average person really overestimates the amount that they need in an emergency fund. And hopefully, I'll be able to show you why that's my perspective. So here are a couple of reasons I think the amount we need in cash in terms of what society tells you is often a bit inflated. When you hear the word financial emergency, it's highly likely that something like a new set of tires or having to fly home for a funeral comes to mind. For a longer period, maybe there's a period where you can't work due to maternity leave or there's an unexpected job loss. All of these things are emergencies, and they do require you to have access to some money. What many of them don't require, however, is accessing that money immediately, meaning within 24 hours or one business day. Even the things that do require access to a certain amount of money, like a burst water pipe that leads to you filing a homeowner's insurance claim, or you do need that set of new tires, they don't require you to have access to more than maybe a couple $1,000s at a time. Why is that the case? Well, in some of those expenses that are emergencies, the expense itself is less than that amount, like that set of new tires. Or for others, like the homeowner's insurance claim, all you have to pay on your end is what's needed to meet the deductible to get the repair started. If you take the next couple minutes and try to prove me wrong, I would think you'd be hard-pressed to find more than 3 to 4 emergencies that require more than $2,000 on a day's notice. If you think you found it, make sure it doesn't also carry a deductible that limits your exposure, and we'll tell you how that comes into play. Health insurance, yes, that has a deductible. You could have to pay $1,000 or $2,500 or $5,000 before your insurance company starts to kick in. But if it's a medical bill not covered by the copay, you're typically going to have at least 30 days before that bill becomes due. That homeowner's insurance deductible that we mentioned, well, you can often schedule the work that's due to be completed at your house without even paying that deductible. It could be due by the time the person gets there, which again is likely going to be more than a business day's notice. And even if it isn't, you have an emergency HVAC situation or your house is flooding with no notice at all. Don't know when anybody has noticed when a house floods, but even in those situations, that amount for a homeowner's insurance deductible is typically going to be $1,000 or a couple $1,000s or less. Now, does this mean all you need in your savings account is a couple $1,000s or less? Absolutely not. There are items in emergencies that require larger sums of cash, like a short-term disability or that unexpected job loss. We're simply saying in regards to the timing of the emergencies, most of the ones that are most likely to occur are going to give you at least a week's notice before those funds are due. I keep mentioning that timing because to me, the real benefit of an emergency fund is having access to it within that 24-hour period. Knowing that on a Monday, you can go to a bank and at the latest have the money you need by a Tuesday. That's the real benefit of an emergency fund. But if you have a longer period of time before which you need those funds, then to me there are a number of other options out there that not only will give you access to the money in plenty of time to cover your needs, but also offer the potential for larger returns when compared to what you see in a savings account. So now let's move on to the second reason I think people overinflate what they need in their savings. As much as you might hear about stocks online or see things like meme stocks like GameStop and AMC, actually only about half of the people in this country have money invested in the stock market. And the lower you go in terms of income, the less likely you are to own stocks or be invested at all. As a matter of fact, when it comes to households earning $40,000 or less, only about 24% of them are invested in the market. Ironically, these are the people who statistically have the hardest time establishing that emergency fund, but they're the ones who would benefit the most from a positive year of returns, if only they were invested. Now, let's be clear. Most of the reasons these people can't save have nothing to do with their financial habits. They might have terrible pay at their job. They might have high costs of housing. They might have high student loan balances. All of these factors that are out of their control. But we can't discount the role that fear plays in the average consumer's hesitance to enter the stock market. As a matter of fact, they've done some studies on millennial investing habits, or I should say the unwillingness of millennials to invest, and they found some surprising data. 50% of millennials are afraid of making a bad investment and losing money. 35% are intimidated by the amount of money they feel they need to actually invest. 31% don't know who to trust for investment help, and 24% don't know how to get started. Now, in my experience, the fears that many of these investors bring into their first foray into the market often fall into two categories. The fear of them actually having a drop in the value of their investment, and the fear of them losing access to the investment in terms of their ability to go and withdraw funds. And both of these can be addressed. When you've never invested before, it's easy to believe that by simply putting money in the market, that on a scale of 1 to 10 in terms of your level of aggression, that you're automatically at the 10. But that's not how the market works. As a matter of fact, there are plenty of investment companies that structure their offerings so that they fall into a number of categories based on your risk tolerance. And risk tolerance is your ability to look at the rise and fall of what's going on in your account without making a change or feeling the need to make a change. If I can look at an investment that goes up or down 20% over the course of 2 or 3 months and not feel the need to make a change, I might be a pretty aggressive investor. But if I'm the type of investor that if it goes down 1%, I want to pull everything out, I'm going to be a conservative investor. So you're going to see all of these options when it comes to investments based on your risk tolerance. You have conservative investors, moderately conservative investors, moderate investors, moderately aggressive investors, and aggressive investors. And each of them are going to have multiple opportunities to find an investment that meets their interests. As a matter of fact, if you consider yourself a conservative or a moderate investor, and you actually review some of the top performing investments within that risk tolerance, you'll find that not only are the returns far greater than what you see in a typical savings account, but the down years in the market are often not as severe as you might expect. Does this mean you'll always have positive returns? No, it doesn't. As a matter of fact, the first rule of compliance for an investment advisor is to remind you that past performance is not indicative of future returns. But what it does mean is that when you look at your risk tolerance and you find an investment that suits that risk tolerance, you can ease your fears and not feel that by simply investing, you're diving all the way into the deep end. This plays into the emergency savings conversation because to me, once you've identified that emergency savings amount, you don't need to continuously put cash into that account year after year, month after month. You've already met your minimum objective. I would prefer that you give that money an opportunity to grow above and beyond that savings number by dipping your toe into the investment waters. And I typically recommend someone who's starting in this scenario to start with a conservative or moderate fund. So you don't feel like you're going from savings straight to aggressive growth. You can dip your toe in the water by saying on a scale of 1 to 10, I'm going to invest at a 3. And as those funds build up, maybe as they get higher and higher with those latter portions, I can be more aggressive. Since I work with typically younger investors, maybe 45 or under, they can't access things like their traditional retirement accounts for over a decade. And for many of them, their retirement accounts are the only experience they have in the stock market. So it's natural when they think about establishing investments outside of their emergency savings that they would feel they would lose access to that money because the only other investment they have, they can't access now. But that's not the case. Workplace retirement plans are often qualified plans, and qualified plans carry with them some restrictions. One of those restrictions being that you can't access the funds without penalty until a particular age, often age 59 and a half. But what we're talking about with funds beyond emergency savings are non-qualified accounts. And non-qualified accounts carry no such restrictions in terms of the age you have to be when you access your funds. You can not only touch this money when you need to, but if you chose to withdraw money from a non-qualified account, it can typically be back in your cash savings account within the time of a business week. And remember that time in conversation when we discussed what constitutes a truly urgent financial matter. To me, it's one where you need access to money within 24 hours. With a non-qualified account, you might be able to have access to money on a Friday that you requested on a Monday, which is often plenty of time to cover your standard financial emergency. So how much do you actually need in your emergency fund? Well, to me, it depends on a number of factors. I do think that 3 months of expenses is a safe number, especially for a 2-income household. These 3 months expenses are likely enough to cover the deductibles for any major concerns you might have, like a short-term disability or health insurance. And they also line up with the typical average period of unemployment, which is right at 4 months. But here's what's important to remember when you add in the discussion about establishing non-qualified investments. I actually want you to have access to far more than 3 months expenses. Unlike qualified retirement accounts, which have contribution limitations each calendar year, non-qualified investment accounts have no such restrictions. So why not have access to up to a year's expenses, or even more when there's no limit on what you can contribute? When you add this with your emergency fund, you don't have to place a cap on what you have access to. We're just talking about how much you need in pure cash. And to me, for a 2-income household, 3 months expenses is sufficient. There are always exceptions to this rule, and here are a few scenarios where having more than 3 months expenses in cash is a good idea. The first is if your income fluctuates. I'm a financial advisor, and I've been doing this a long enough period of time that I do have some level of dependability in terms of what I'm going to earn from year to year and month to month. That being said, my income is still based off of commissions and fees and services rendered, and sometimes you have a log jam of money that's due to be paid to me, but is not in my account right now. There could even be a month, even this deep in my career, where the expenses that I have to pay on a monthly basis are more than what I brought in on that month. Now, the next month, I might bring in way more than what's needed to cover my expenses, but having a high cash balance in my account is something that really helps me in periods where my income fluctuates. So as ironic as this sounds, when you're watching a video about me saying you don't need that much money in cash accounts, I happen to be in a field where keeping a higher cash balance benefits me more than the typical consumer. Next is when you have a large upcoming expense, and it could be a good expense or a bad expense. Maybe you're in a position where you're trying to buy your first home or your dream home, and you're within 3 months of the purchase. Well, having that money in the market that you might need for the down payment can be a positive thing if the market has positive returns, but we all know that that's not guaranteed. And what you want in this period of time where you're so close to making that purchase is the comfortability and dependability of knowing that every single dollar you put aside will be there when you need it. So this is actually a scenario where when you're within 3 to 6 months of a large purchase, where you want to keep all of the funds that you need to make that expense work in cash savings rather than risking a potential downturn right before you pull the trigger. And lastly, if you have either poor health insurance or no health insurance, or a poor health history where you know you're much more likely to be in the hospital or need some type of care on a consistent basis, having a large amount in cash can protect you from an unexpected medical expense. Even if you've decided that you'd like a larger amount than I would recommend in savings, or a lower amount because you agree with some of the points that I've made, you can start a plan to get saving today to establish that emergency fund. Let's look at an example of a family who wants to keep 6 months' expenses in cash savings, and they devote $500 a month to their goal. We can help them reach it with a tiered savings system. First, what we would recommend is they take their $500 monthly savings and they put it in their savings account. No risk at all. They're establishing their funds, so they're going to put their entire $500 into their savings account. And they're going to do so until that savings account reaches the 3 months expenses. This is our minimum expectation, so we're not going to risk any of these funds until we meet that objective. After they've reached that objective, they can start to dip their toe into the investing waters, and they can find an option that is aggressive or conservative based on what makes them comfortable. But as I said, if they're just getting started, I typically recommend a pretty conservative or moderate investment. So then instead of putting the whole $500 towards savings, they're now going to split it up. And $250 is going to savings, and the other $250 goes to fund that investment account. So they're getting the ball rolling on that end, and they're going to continue with this strategy until that savings account reaches their 6 months expenses. So if you're keeping up, it's going to take them twice as long to get from that 3rd month to the 6 months expenses saved. But this entire time, they're also establishing their non-qualified investments. After they've reached that 6 months expenses, however, they can now put that entire $500 monthly contribution to their investment account moving forward. They've met their long-term savings goal, and there's no reason to keep padding this account because you're not giving that money an opportunity to earn a rate of return. So they can redirect their efforts and know that they not only have enough money saved for any likely financial emergency that could occur, but any additional funds on top of that have that possibility for a rate of return. That's it. Deciding how much you keep in a savings account is a personal decision. And I have my opinion, and it's an informed opinion, but it is still just an opinion. I hope you use this information to look at the factors present in your finances to determine the amount that's right for you. But the part of this that I hope you don't skip over is determining your risk tolerance and deciding how you would like to enter into the market. It is next to impossible to save your way to wealth if you're not giving your money that opportunity to work on your behalf. And I encourage you to take those steps to find out what gives you that place of peace, that middle ground, and then move forward financially to that objective. My name is Brenton Harrison. If you haven't already, please subscribe to us on YouTube and subscribe to the notifications so you know when new content's being posted, and we'll keep bringing it to you as quickly as we can. See you soon.